everyone. I'm joined again with Jason Harris from Guaranteed Rate, here to answer all of our questions on what is going on in the market and help you strategize your home purchase for the future based on kind of what is in the news and what is applicable to you right now. Jason, explain to me what an ARM is.
Well, Laura, thanks so much for having me. ARMs are, kind of all the rage. We're hearing a lot about them lately. They stand for adjustable rate mortgage. It's a loan that is, it's usually fixed for a specific period of time. There are options anywhere from 3 years out to even as much as 15 years. So the rate will be fixed for an introductory period. At the end of that introductory period, the rate would then become variable based on market. So it's a strategy that right now it can be. I've been doing this now for about 20 years. I'd say most of the time I'm not a huge advocate for ARMs. In this market, I think there's a place for them. Again, not necessarily a perfect fit for a first-time buyer. When you think about a rate that's only fixed for 3 or 5 years. But if you're an experienced buyer, if you're aware that you intend to be in a home for a specific period of time, the savings relative to the fixed rate is really about as big as it's ever been. We're seeing about a full 2% difference between the fixed rate and the adjustable rate programs right now.
So who are they good for and who are they not good for?
Great question. Yeah, the kind of the perfect scenario, or the ideal buyer that would utilize an ARM would be somebody that has a larger down payment. I think 20% down would be ideal. The reason I say that is you are going to want to refinance. If you have an ARM, it's probably not a loan that you're necessarily going to keep for the full 30 years. And having that great equity position will put you in a good spot to refinance. Also, if you've got a buyer that's coming into town for a job that they know is a 4 or 5 year time horizon. If you have an idea of how long that you plan to be in the home, kind of on a high end, it can be a scenario where you'd get some savings for the first 5, 7, again, or even 10 years.
What kind of advice are you giving to first-time home buyers right now? And what is their best strategy to save money with interest rates going up as they are?
Yeah, well, here's the great news. First-time home buyers are actually coming back to the market. We saw, the last couple of years, it was really hard as a first-time home buyer to be able to dip your toe in and compete in the market that we've been in. Now it's still a strong market here in Columbus, but we're seeing first-time home buyers that have an opportunity to be able to make an offer, win a bid, be able to actually move into a home. The strategies that we're looking at with most first-time home buyers there are a lot of incentives available. There is a program, the Mortgage Tax Credit Certificate, that will provide first-time buyers with a rebate on the total mortgage interest that they pay annually. That rebate will be somewhere between 20 and 40% of the total mortgage interest. So that's a fantastic benefit. There are grant programs available right now that you can do, 2.5 or even 5% as a grant towards down payment. So we've had a lot of success helping first-time home buyers understand those options, and interest rate buy downs. Right now, in a competitive market, we're unable at all to negotiate credits or price or anything at all with the seller. In this market, we are seeing some opportunities, again, not across the board, but we're seeing some opportunities where a buyer may be able to ask the seller to help them buy down their interest rate through seller credits. And that's a strategy we've had some success with over the last couple of months.
When is it most beneficial for someone to buy down an interest rate? What is that kind of year break-even point if you might only plan to be in your house for 3 years versus if you plan to be in that house for 10, 15 years? When does it make sense to put money towards buying down a rate?
Yeah, that's a great question. There are 2 different types of rate buy downs. There is a permanent rate buy down where you're going to pay an extra amount of money that's going to reduce the interest rate for the full duration of the loan. In those scenarios, I think a buyer has to experience a break even. So they've got to kind of get the money back by virtue of the savings on the lower rate within a 3 or 4 year period for that to make sense. There's a great product we've actually rolled out recently. It's a temporary interest rate buy down where they can buy their interest rate down 2% in the first year and 1% in year two. And that's a great option right now, especially if you find a property where you may be able to negotiate a credit from the seller. These can be funded through seller credits, and it allows you to get a payment that's going to be much lower in year one, still a nice savings in year two. And then again, year 3 through 30 would be fixed at a 30-year rate moving forward. So long-term buy downs, I think you have to be there a minimum of 3 years. For the temporary buy down, that's something that even a 1 or 2 year situation could make sense.
Is the thought that we can look ahead and rates might go down in the future? So some people can plan maybe a refi is on the horizon. If the house that they find is still within their budget, there might be an opportunity to save down the road.
Yeah, exactly. So with the temporary buy down, it provides a 2 year period of savings. Year one is a really meaningful savings with that 2% reduction in the rate. Year two is that 1% reduction. And many first-time home buyers are at a stage in their career that they understand that their income will be going up over time. So, we want to prepare them for that final payment in year 3 through 30, but it also provides the assurance of a fixed rate from year 3 through 30. So it's a kind of a great affordability tool to get in the door when rates are a little higher. And it provides some of the benefits of the fixed rate program, given that the rate is secure for years 3 through 30.
So it really sounds like right now, to make the best financial decision and really to save the most money, everybody's scenario is going to be different, and what works for everybody is going to be different.
Yeah, I think that's fair to say. There has really never been a more important time to work with an expert, whether that's an expert real estate agent, an expert lender. The market now, it's still, again, here in Columbus, a strong market, but there are opportunities to find discounts, to find homes that you can ask the seller to credit, maintain your contingencies, and really having an expert realtor to help you make those decisions right now is never more important. And then as far as the lending goes, it's just, again, to your point, so situational. We've got to look at all of the different options. We've got to understand your budget and make sure we find the savings opportunity that makes sense for you.
If someone is out there looking for a great loan officer, and maybe they're watching this and not in our particular market, what should a buyer be looking for when talking to a mortgage officer and loan officer?
Well, as I'm now entering my 20th year in the industry, I don't want to date myself, but I think experience matters, right? Both in real estate and we've seen probably 30 or 40% of loan officers have really just started. Right now, it's so important to have somebody that has seen a little bit of this before, has been through a few markets, has had the opportunity to kind of have these same strategic conversations with buyers over the years, and is going to be able to tailor a solution that's appropriate for your needs. So experience, expertise. I think the most important thing is they need to know what they're doing right now. This is not a time for folks that are just getting started.
Great. Thank you. And I know that's helpful. Again, this is really a time where I can give kind of blanket advice as much as I can, but really the best thing to do right now for anyone is to pick up the phone and call someone like Jason and really talk them through your entire financial picture to really find out, is this a good time? Should you wait? Should you go for something now? And what that looks like for your finances. So I always appreciate the education, and I'm sure we'll be back with more questions soon.
Thanks so much, Laura. I appreciate you having me.